What's up, everybody? Meta just reported earnings. They reported a decline in revenue. The stock is down. It's down, I think, 50% this year. I've shared that I have a position in Meta. I just made a huge change to the position, which I will share in this video, and we'll cover the earnings. So as you can see, pre-market, Meta is down 4%. Yesterday, they were up 6.55%. We can see the 52-week low was 154, and that happened June 23rd, so about a month ago. And the 52-week high is 384, so way down from the 52-week high. I'm going to talk about if I think the stock's going to get back up to that 52-week high. But if you know me and you've watched this channel before, you know I am building this $1 million portfolio transparently right here on YouTube and sharing every step of the journey. If you like that content, do me a favor and like this video, subscribe to the channel. It really helps more people find us and it helps support the channel. So you can see the current value of the portfolio is $73,250. If you've seen my previous updates, that's a big jump. So what happened? No, my stocks didn't magically go up. I added money to the portfolio. I made a big contribution of $8,500 additional dollars above my plan of adding $3,000 per month, because when I'm able to, I'm gonna add more money to this portfolio, because that's how you grow wealth over time. We've now put in $82,500 since February 15th, 2023 or 2022. We are down $9,200, which isn't great, but I like my portfolio. I like the companies I own, and this is a long-term portfolio. Yesterday, we were up big. We were up $4,000. The market rallied yesterday, and you can see yesterday alone, Datadog was up 10%, the Trade Desk was up 9%, MongoDB was up 9%, Snowflake 9%, Cloudflare up, Tesla was up, everything was up, and even Meta was up yesterday. And you can see that the change I made to my metaverse position, this was before earnings, or to my Meta platforms position, was I made a big buy in Meta. If you want to look back at the videos on the channel, you can see other reviews I've done where I shared my price target of Meta previously. I also have an email newsletter, austin.substack.com, where I let my subscribers know what I'm gonna buy before I buy it. So if you want that, just check out the newsletter. It's down in the description. But I told them before I bought the stock. So what we're gonna do now is we're gonna jump into Meta's earnings, and I'm going to look at some of the highlights from their press release and how I'm thinking about the stock now. This is concerning, right? $28 billion, almost $29 billion in second quarter 2022 revenue. That is down 1% from last year. So we're going to talk about that major concern. There's a narrative out there that that's the death of Meta, the death of Facebook platforms. I'm going to tell you a little bit why I think that's not necessarily true. Another concerning thing, costs were up 22%. Revenue's going down, costs are going up. That's at least a yellow flag. Income from operations down 32%. Operating margin, it was 43% in the second quarter of 2021. Now it's 29%, also concerning. The net income down 36% and diluted earnings per share down 32%. So lots of concerns there. And this could be a sign of a declining company and a company that we don't want to be invested in. And full disclosure, that very well could be the case with Meta. I don't think it is, and I'm going to talk about why. So what we're seeing here is that their user base, when it's 2.88 billion daily active people, monthly active people, $3.65 billion. There is no platform in the world, to my knowledge, with that kind of scale. They still grew 4% year over year on the daily, and they grew 4% year over year monthly. Facebook daily active users were 1.97 billion on average, for an increase of 3%. Monthly active users was up 1%. Here's what happened. Here's why the revenue is negative. Ad impressions delivered across our family of apps increased by 15% year over year. More impressions were showed, which is great, but the average price of the advertisement decreased by 14% year over year. So because of this macro situation, there is essentially just the pricing that they're able to charge for advertisements has gone down. But the total impressions have gone up. That's because of that growing user base. That's because their algorithms and their AI is getting better at the discovery part of it, all of that stuff. But the price is down. And so if that were to happen every quarter after quarter, that would ultimately be the end of Facebook's business if the revenue decline is too much. But advertising can be cyclical. And with all of the challenges they've had with Apple's privacy changes, all of the challenges that they've had in the macro environment with ad budgets being adjusted and shifted and all these unknowns creating just caution for companies and marketers, that's to be expected. And it's not, that trend might continue for another quarter, another 2 quarters, maybe even 3 more quarters, but it's not going to continue forever. They are also cannibalizing their advertising revenue a little bit because they are purposely trying to grow Reels on Instagram, which is short form video. It's their response to TikTok, their response to YouTube Shorts. We are seeing demand and impressions for those grow a lot. I think it was up 30% year over year. They're not as good at monetizing that yet because it is a new form of monetization. And so they are purposely replacing things like stories and other types of advertising that they had on the platform with Reels that they're not able to monetize as much yet. Eventually, once they get good at it, that is gonna flip and they're gonna get better at monetizing that than they were at monetizing previous content types, and they're still gonna monetize their other content types. And so that's why I think this revenue decline is temporary. They are spending a lot in capital expenditures. They are spending a lot in investments on people in the metaverse. What Zuckerberg said during the call is that they're gonna slow hiring, they're gonna slow some of these investments, and these are investments for 3 to 5 years out in the metaverse. They're still investing in it, but they're just prioritizing more. So they're going to slow their spend in those capital expenditure costs. They're going to get through this environment. They have a very strong balance sheet. They have their cash to debt ratio is just extremely, they could essentially pay off all their debt with the cash on the balance sheet, and they're still bringing in free cash flow every quarter. And so they're going to be able to keep investing with that. They're also going to, in my opinion, once things stabilize, probably buy back more shares than they have previously. So they purchased $5 billion of Class A common stock in the second quarter, and they had $24.3 billion available and authorized for repurchases. The market cap is around $450 billion. So on their current plan, they could still repurchase about 5% of shares outstanding. What I think will happen once things stabilize is they're going to authorize, especially if the shares stay down and they feel that the stock is undervalued over the long term, they can get another authorization to buy back more shares in the years to come. And I think that they will do that if it makes sense. But Zuckerberg is a smart capital allocator, and I love what they're doing, the confidence they have, the user base that they have to be able to leverage into the future. And I love that they're investing for the metaverse, not just sitting on this advertising business and thinking that they're going to be okay. Let's see what they actually reported in terms of EPS and earnings, right? Earnings per share was $2.46. They missed that by 9 cents. So that means analysts were expecting it to be $2.4 or $2.55. They missed on revenue by 129 million. They still reported 28.8 billion, so that was down almost 1%. So you could see these red right here are misses. They've had a few tough quarters. They've had a tough year or two. But look at the history of this company. I mean, this platform is not dying. We're seeing their user base growing. We're seeing the investments that they're making. And so if we take a look at Fast Graphs, this is a charting tool essentially, and but it uses fundamentals, not technicals. And so by fundamentals, I mean earnings growth. It shows their PE ratio. And what this black line shows is that their blended price earnings ratio, which is a mix of their historical earnings plus expectations for the future, is 13.81. Facebook has, I don't think it has ever traded since it's been a publicly traded company at 13.81. And so analyst expectations for growth in the future, earnings growth in the future, they're expecting, this was already, before yesterday, this was already expected that they're going to grow earnings at negative 19% for this year. There's a chance that deceleration is going to be a little bit worse than this, but to me, that doesn't really matter that much. I mean, if it's negative 25%, whatever, it's not that big of a difference. And then they're only expecting it to grow 14% off of this negative, number. So they're at 1377 in 2021. They're expected to go down to 1116 in earnings in 2022, and they're only expected to rebound to 1269, and then finally back up to 1505, meaning that from 2023 to 2024, they would finally grow past the earnings number that they had, the EPS that they had in 2021. So they're not expecting, analysts are currently not expecting this company to blow the doors off. They're expecting this slowdown. So I think a lot of this negative news is already baked in. And so what this does is we could just take this and we can say, okay, with these analyst expectations, even if we stay at 13, let's see what happens if we stay at a PE of 13.5 out to 2024, you're still looking at a total annualized return of almost 8% for a total rate of return of just about 20%. If that PE gets up to 16.5, which isn't a stretch, there's a lot of companies growing earnings a lot slower than that trade with lower gross margins and lower operating margins and lower profitability, that trade at a much higher PE than 16.5. So if Facebook even gets to a PE of 16.5 in 2024, you're looking at a 17% annualized rate of return for a 46% total return. So, Facebook is a company that if I don't buy the narrative that the company's dead, the stock is dying, users are all going away. That's a popular narrative out there, but the numbers just aren't showing that. They grew their user base even with shutting off service in Russia, where they intentionally lost all of those users. And so I think at some point, this metaverse bet is going to start to pay off. It could be 5 or 10 years, but that's the way I invest. And if you like that, then again, do me a favor, like the video, subscribe to the channel, and stick around. We're going to be reviewing Google, Amazon, Apple report this week. Let me know in the comments what company you want me to review. And I love to do subscriber request reviews as well. Have a good day, everybody.